We're 18 months out, maybe less. The next crash isn't speculation, it's mathematics. The debt, the leverage, the derivatives, they've all reached levels that make 2008 look like a practice run. Commercial real estate is already imploding. $2.7 trillion in buildings nobody wants. Financed with debt nobody can refinance. Banks are hiding losses. Accounting tricks keep buildings performing when they're 40% vacant. Corporate debt hit $10.5 trillion. Most of it borrowed at near zero rates that no longer exist. Refinancing starts in 2026. At current rates, half these companies can't survive. The warning signs aren't subtle. They're screaming, but markets keep climbing because everyone thinks they'll exit before it breaks. Welcome to Financial Rewind. I'm here to show you what's coming before it arrives. And today, we're mapping the 2026 to 2027 crash, the converging debt bombs, the hidden leverage, the mathematical certainty that what goes up must come down, and why the next 18 months will determine whether you're positioned to survive or positioned to lose everything. This isn't prediction, it's pattern recognition. Every data point says the same thing. The crash is already built. It's just waiting for the trigger. Let's start with what makes this different from 2008. Worse, actually. In 2008, the problem was subprime mortgages. About $1, $3 trillion in bad loans that brought down the system. Today, multiple time bombs. Each one larger than 2008, all detonating simultaneously. Time bomb 1. Commercial real estate. $2. $7 trillion in commercial mortgages. Office buildings. Shopping malls. Hotels. The problem, nobody wants office space anymore. Remote work gutted demand. Office vacancy rates hit 20% nationally. In cities like San Francisco, 35%. But here's the mechanism that makes it systemic. These buildings were appraised at 2019 values. Banks lent 70-80% of those valuations. A building worth $100 million in 2019, the bank lent $75 million. That same building today, worth $60 million, maybe less. The loan is underwater. The owner can't refinance. Can't sell without taking a massive loss. So they keep paying, hoping values recover, using reserves, burning cash, praying. But $1. $4 trillion of these loans mature between 2024 and 2027. Peak refinancing hits in 2026. When these loans come due, one of three things happens. 1. The owner refinances at current rates, 8 to 9%, instead of 3 to 4%. The higher payments crush cash flow. Building goes into default within months. 2. The bank extends the loan, pretending everything's fine. Extend and pretend, but this just delays the problem. And regulators are starting to notice. 3. The building sells at current value. The bank takes a 30-40% loss. Write-downs hit capital ratios. The bank fails. All three outcomes lead to crisis, and we're talking about $1. $4 trillion in loans hitting this wall simultaneously. For context, the entire subprime crisis was $1. $3 trillion. Time bomb 2, corporate debt maturity wall. $10. $5 trillion in corporate debt. Most issued between 2020 to 2021 when rates were zero. Companies borrowed to survive COVID, to buy back stock, to fund acquisitions, because money was free. But those bonds mature. $5 trillion comes due between 2025 and 2027. When they refinance, rates will be triple what they originally paid. A company paying $100 million annually in interest will suddenly owe $300 million. Can they afford it? Let's look at earnings. S&P 500 companies have debt equal to 2-3x their annual earnings. Historically high. Interest coverage ratios, how many times earnings cover interest payments, are at the lowest levels since 2008. Translation, companies are already stretched, and interest costs are about to triple. What happens? Defaults, bankruptcies, layoffs, credit freezes. The weakest companies fail first, but their failures cascade. Suppliers lose revenue, banks take losses. Contagion spreads. Time bomb 3, private credit market. This one's invisible until it explodes. Private credit lending by non-bank entities like private equity and hedge funds has grown to $1, $5 trillion. These loans aren't regulated like bank loans. No capital requirements, no stress tests, no transparency. They're made to companies that can't get bank loans, higher risk, higher leverage, and they're structured with floating rates. When interest rates rose in 2022 to 2023, borrowers started struggling immediately. Default rates in private credit hit 5% in 2023, double the 2021 rate, and climbing. By 2026, when refinancing hits, defaults could reach 10-15%. That's $150 to $5 billion in losses. Who holds these loans? Pension funds, insurance companies, university endowments. When losses hit, those institutions face redemptions. They have to sell assets, stocks, bonds, real estate to meet withdrawals. Forced selling into falling markets. Accelerating the crash. Time bomb 4. Derivatives. The shadow leverage. The thing that turned 2008 from a crisis into a catastrophe. Total global derivatives. $600 trillion notional value. Most are interest rate swaps. Banks and corporations hedging against rate changes. But here's the problem. These swaps assumed rates would stay low. When rates spiked in 2022 to 2023, the hedges broke. Banks like Silicon Valley Bank had massive unrealized losses on their bond portfolios. Their interest rate hedges didn't cover it. SVB failed. But it wasn't alone. Hundreds of regional banks have the same problem. They're sitting on $650 billion in unrealized losses on bonds and securities. Hidden on balance sheets, marked available for sale or held to maturity so they don't have to recognize the loss until they need liquidity, until depositors withdraw, until they're forced to sell. Then the losses become real and the bank fails. 2026 to 2027, when commercial real estate and corporate debt start defaulting, banks will need liquidity. They'll have to sell securities. $650 billion in losses will materialize. Simultaneously. Now, let's talk about the trigger. What event starts the cascade? It won't be obvious. It never is. In 1929, it was a stock margin call. In 2008, it was a French bank announcing losses on subprime. In 2020, it was a virus nobody had heard of. The trigger is always something that exposes the leverage. For 2026 to 2027, here are the candidates. Trigger Scenario 1. Major bank failure. A regional bank with heavy commercial real estate exposure fails. Could be any of the 100 banks sitting on unrealized losses. Depositors at similar banks panic. Bank run spreads. FDIC can't cover all of them. Its fund is only $128 billion. The Fed has to intervene. But this time, after SVB, there's political resistance to bailouts. Delay causes contagion. Banks freeze lending. Credit markets seize. The crash accelerates. Trigger Scenario 2. Corporate default cascade. A major retailer or commercial landlord files bankruptcy. Not surprising in itself, but it triggers credit default swaps. Billions in payouts to entities betting on default. Those entities were using the expected payout as collateral for other bets. When it pays, they use it to cover losses elsewhere. But if multiple defaults happen simultaneously, the system can't process the payments fast enough. Counterparty risk explodes. Nobody knows who's solvent. Trading freezes. Markets crash. Trigger Scenario 3. Sovereign debt crisis. Italy's debt to GDP is 145%. Japan's is 264%. If bond markets decide either country can't sustain that debt, yields spike. Italy paying 7% on bonds, the level that triggered crisis in 2011, would consume half the government budget in interest. Default becomes inevitable. But Italy is the Eurozone's third largest economy. Contagion spreads. Spanish, Portuguese, Greek bonds sell off. The euro crashes. European banks holding trillions in sovereign debt face massive losses. U.S. Banks have $2.5 trillion in exposure to European banks. When Europe crashes, America follows. Trigger Scenario 4. Geopolitical shock. Taiwan. Ukraine escalation. Middle East war. Oil prices spike to $150. Supply chains break. Inflation returns. The Fed, which had been cutting rates to support the economy, has to choose. Let inflation run or crash the economy with rate hikes. Either choice triggers crisis. Inflation destroys purchasing power. Rate hikes destroy asset values. Markets collapse either way. Here's the timeline, month by month, how this unfolds. Now through Q1 2025. Markets remain elevated. Corporate earnings hold. Real estate owners delay reckoning with extend and pretend. The music keeps playing. Everyone dances. But beneath the surface, defaults rising, commercial vacancies increasing, corporate interest coverage declining. Q to Q3 2025. First wave of commercial real estate refinancing hits. Some buildings can't refinance. Defaults begin. Banks start extending loans, pretending losses don't exist. But some smaller banks can't hide. Failures begin. Not headline making yet. Regional banks and secondary markets. Q4 2025. Q1 2026. Corporate debt matures, accelerate. High-yield bonds start defaulting. Default rates hit 5%, then 6%. Credit spreads widen. Borrowing becomes expensive for everyone. Stock market volatility increases. The S&P has a 10-15% correction. Healthy pullback, analysts say. Q2 2026. The dam breaks. A major commercial landlord files bankruptcy. Brookfield, maybe. Or SL Green. Billions in debt defaulted. Banks holding those loans take massive write-downs. One regional bank fails outright. Depositor panic spreads. The Fed steps in. But political climate has changed. No more blank checks. Q3 2026. Credit markets freeze. Nobody trusts anyone's balance sheet. Lending stops. Corporations that need to refinance can't. Bankruptcies accelerate. Stock market crashes 30%, then another 20%. Treasury yields collapse as everyone flees to safety, but corporate bond yields spike to 15-20%. The divergence signals systemic stress. Q4 2026, Q1 2027. Contagion goes global. European banks, overexposed to U.S. commercial real estate and corporate debt, face crisis. Italy or Greece defaults, the euro crashes. China, whose banks hold trillions in dollar-denominated debt, faces simultaneous crisis. Global trade freezes. Supply chains break. By Q1 2027, markets are down 50-60% from peak. Unemployment hits 12%. The recession is officially worse than 2008. This isn't speculation. This is the mathematical result of current debt levels hitting maturity walls with higher interest rates. Now, here's what makes this crash different and more dangerous. 1. The debt is bigger. 2008, total U.S. debt was $50 trillion. 2024, total U.S. debt is $98 trillion, double. Corporate, household, government, all at record levels. 2. The Fed has less room. 2008, Fed cut rates from 5.25% to 0%, 525 basis points of stimulus. 2024, rates are already at 5.25%. They can cut to zero again, but that's only 525 basis points. And zero rates didn't prevent crisis in 2008. Why would they now? The Fed also expanded its balance sheet from $900 billion to $4.5 trillion during the 2008 to 2020 period. It's already at $7.8 trillion. How much more can it buy without destroying the dollar's credibility? 3. Asset prices are more inflated. 2008, S&P 500 P/E ratio was 21 at the peak. 2024. P divided by E ratio is 27. Higher valuations equals further to fall. Real estate prices are 40% above 2008 levels adjusted for inflation. The everything bubble. When it pops, everything falls. 4. Political dysfunction. 2008. Democrats and Republicans fought over TARP, but they passed it. 2024. Political polarization is far worse. Trust in institutions has collapsed. Will Congress approve bailouts this time? Unclear. Delay could turn a crisis into a catastrophe. 5. Global interconnection. 2008 was mostly a U.S.-Europe crisis. 2024. China has $60 trillion in debt, much of it tied to dollar-denominated loans and trade. When the U.S. crashes, China crashes. When China crashes, global supply chains break. There's no corner of the world economy that's insulated. So what can you do? How do you position for this? If you believe the thesis, 1. Hold cash. Not all in one bank. FDIC only covers $250,000 per account. Spread across multiple institutions, include credit unions. Cash lets you buy assets when they're on sale during the crash. 2. Avoid commercial real estate exposure. REITs, office building funds, retail property investments. They're going to get hammered. Values will fall 40-60%. 3. Reduce high-yield corporate bond exposure. If you hold junk bonds or leveraged loan funds, exit now. Default rates will spike. Recoveries will be low. 4. Consider treasury bonds. In a crisis, everyone flees to treasuries. Prices rise, yields fall. Long-term treasuries, 20 to 30 year, gain the most in a flight to safety. 5. Gold. If the Fed responds with massive money printing, gold protects against inflation. If deflation hits, gold holds value while everything else falls. Either way, 5 to 10% allocation makes sense. 6. Prepare for volatility. If you're in stocks, expect 50-60% drawdowns. Can you stomach that? If not, reduce exposure now. If yes, have cash ready to buy at the bottom. 7. Career defensibility. Unemployment will spike. Make yourself indispensable. Essential skills. Diversified income, emergency fund covering 12 months of expenses. Now, here's the other side. What if this is wrong? What if the Fed cuts rates, prevents the crash, and markets rally another 30%. Possible, the Fed has pulled off soft landings before, but here's the math. If you're positioned defensively and markets rally, you miss gains but don't lose capital. If you're fully invested and the crash hits, you lose 50-60%. Asymmetric risk. The downside of being wrong is far worse if you're optimistic. This is why even permabulls should hedge. Let me show you why the timeline matters. If the crash hits in Q4 2025, it's too early. The debt maturity wall hasn't fully hit. The Fed can still extend and pretend. If it hits in Q2 2027, the damage is already done. Most of the losses have materialized. You're late to position. Q2, Q3 2026 is the sweet spot. Maximum debt maturing, maximum refinancing stress, maximum convergence of all 4 time bombs. That's 18 months from now, maybe 20. This is the window to prepare. Here's the human cost. Because numbers don't capture what this means. 2008, 10 million Americans lost homes. $19 trillion in household wealth evaporated. Unemployment hit 10%. This crash will be worse. 15 to 20 million could lose homes. $30.40 trillion in wealth could evaporate. Unemployment could hit 12-15%. Retirement accounts halved. Pensions collapsed. Life savings gone. Not because people made bad decisions. Because the system is over-leveraged and the math doesn't work. When debt exceeds the ability to repay, default is inevitable. The only question is timing. Let's talk about bailouts, because that's the wild card. In 2008, the government stepped in. TARP, Fed lending, guarantees. $16 trillion total when you count everything. Will they do it again? Politically, it's harder now. Public anger at 2008 bailouts never went away. And the numbers are bigger. If this crash requires $30.40 trillion in support, where does it come from? The Fed can print it. But at what cost to the dollar? If the dollar loses reserve status, the game ends. The U.S. can't run trillion-dollar deficits without consequences. So the Fed faces a choice. Save the system and risk the dollar, or preserve the dollar and let the system collapse. There's no good option, only least bad. And that choice will determine whether this is a depression or just a severe recession. Now, here's the pattern that makes me confident in this timing. Debt cycles run 15 to 20 years, peak to peak. 1987 crash, 2000 dot-com crash, 2008 financial crisis, 2020. COVID crash postponed, not resolved. We're due. 2026 to 2027 fits the pattern. But it's not just patterns. It's math. Debt service costs as a percentage of GDP are at 1,980 seconds levels and rising. Corporate debt-to-equity ratios are at 2007 levels. Commercial real estate vacancy rates are at 1,990 seconds crisis levels. Every metric says unsustainable, correction required. The only debate is when, not if. Let me address the counter-argument. They won't let it crash. Who's they? The Fed? The government? The Fed can provide liquidity. But it can't create solvency. If companies are fundamentally unprofitable at current interest rates, the Fed can't fix that. If buildings are fundamentally worth 40% less than their mortgages, the Fed can't fix that. Liquidity prevents panic, but it doesn't prevent economic reality. At some point, the losses have to be recognized. The debt has to be restructured. The pain has to be felt. The Fed can delay it, spread it out, but it can't prevent it. And the longer they delay, the worse it gets when it finally breaks. Here's the scenario I'm most worried about. The Fed delays too long, keeps rates high to fight inflation, refuses to cut until it's obvious the economy is breaking. By the time they cut, the damage is done. Defaults have cascaded, banks have failed, credit markets have frozen. They cut to zero, start QE. But it's too late. The crisis has momentum, like 2008, but the Fed is 6 months late. That's the nightmare scenario, because once the cascade starts, it's hard to stop. So here's what I'm watching. The signals that tell me the timeline is on track. Signal 1. Commercial real estate default rates, currently 2.5%. If they hit 4% by Q2 2025, we're on schedule. Signal 2. Corporate credit spreads. The difference between corporate bond yields and treasury yields. Currently 300 basis points for high yield. If it hits 500 by Q4 2025, stress is building. Signal 3. Bank deposit flows. If regional bank deposits start declining consistently, it means confidence is cracking. Signal 4. Fed policy. If they cut rates in 2025 despite inflation, it means they see something breaking. Signal 5. Insider selling. CEOs selling stock, private equity cashing out, smart money exiting. All 5 signals together, the crash is imminent. Let me be clear about what this is and isn't. This is not market timing advice. I'm not telling you to sell everything today. This is pattern recognition. Debt levels plus maturity walls plus interest rates equals mathematical stress. The crash is built into current conditions. The trigger and exact timing are uncertain, but the window is narrowing. 18 months, maybe less, maybe 24. Enough time to prepare, not enough time to ignore it. In 2006, people saw housing prices and assumed they'd keep rising. In 2007, the cracks appeared. Smart money exited. In 2008, the crash happened. Most people were caught. We're in late 2024, the equivalent of 2006 to 2007. The cracks are visible. Commercial real estate, corporate debt, bank balance sheets. But markets keep rising. Because nobody wants to be early, nobody wants to miss gains. This is how bubbles end. Not with everyone panicking, but with everyone knowing it's unsustainable and hoping they can exit first. History doesn't repeat, it reveals. And right now, it's revealing that we're 18 months from a crash that will make 2008 look like a warm-up. $2.7 trillion in commercial real estate, $10.5 trillion in corporate debt, $1.5 trillion in private credit, $600 trillion in derivatives, all converging, all maturing, all breaking. Between now and Q3 2026, welcome to the countdown, the 2026 to 2027 time bomb, the one that's already ticking, the one where the only question left is whether you'll be ready when it detonates.